That's fine.
Okay. Thanks everyone for attending tonight's session. I'll share some slides with you and then we will kick off. Hopefully everyone can see that. So before I kick off, just those that may not know me, my name is Sachin Maharaj. You can read some of my background bullet points there. In summary, I have spent about 32 years in banking, holding a number of senior roles, and more particularly have had significant contact with the RBA and APRA, who are the regulator for banks, and been a lot of industry forums to discuss the markets, and also spent about 21 years of my working life in financial markets. So I have a fair idea about what happens in the property market. I will hopefully give you some insights in terms of where I see the Sydney property market and where I see actually it going. I do like to make predictions, so and I have made a number of predictions in the past that have been reasonably accurate. So hopefully my insights today will assist you in your purchasing decisions. Okay, without further ado, we will have time for questions in the end. So that is very important to us to make sure we can address every question that our listeners have. So first and foremost, where has the house price growth gone in the last 12 months? Well, you're all aware of this, so I don't need to dwell on this slide, but this is the latest numbers, and that shows you the 12 months price growth to January 31st, okay? This is the latest numbers. So you can see I've highlighted some numbers there for you. Sydney's growth in the last 12 months is 25.5. Last month in January, we still grew 0.6%. So it hasn't stopped, okay? Now, this is quite alarming. I mean, Brisbane, Adelaide, still a monthly growth of 2.3, Adelaide 2.2, Canberra 1.7, combined regional, okay, combined regional across Australia, 1.8%. That is strong as well. These are some really big numbers. And just to put this in perspective for all of you, now, you know, this type of growth has not happened more than 3 times in the last 100 years. So if you look at my last bullet point there, in 1989, we had a 29% growth Australia-wide. Here we are tracking at 22.4 Australia-wide for the last 12 months, okay? And that's, I will emphasize, it's all types of properties across Australia. We're just not talking about one single type of property. We're not talking about one part of the city. We're talking about all of Australia. And in 1950 was the last time when we had another over 22% growth. So we won't go through why it was 111% back then. But it is very important to note that this type of growth does not happen every 5 years or 10 years. It is a very big event that causes this type of growth to happen, okay? And we will try to understand some of the reasons that has caused that, but also more importantly, where we are heading from here. Now, like I said, it is all types of properties across the whole city. Now, if you look here at houses versus apartments, this is one of my big stories for today, or for the night, is that the Sydney house prices actually outstripped where apartment price growth was. And in most of Sydney, actually, if you discount the apartment prices in the inner city suburbs, the North Shore, and the eastern suburbs and so on, where the apartment prices have kept very closely aligned to the house price growth, the rest of Sydney has been quite benign. So in a lot of Sydney suburbs, you will find that apartment prices have only grown somewhere between 5 and 6%, okay, in the last 12 months. So there is a big disparity in the numbers. Now, everyone's looking at the monthly price growth, and this is just Sydney, by the way, okay? You've just seen the number for January. So January was 0.6, which has bucked this trend of coming down. So we've been coming down since September. Okay, our big month was March 2021, where we grew 3.7% in 1 month. That was a massive month. And since then, we've had mixed results, but for a monthly growth at these type of percentages is massive. That's what equated to the big 20% plus. And then this trend continued down. And of course, whenever you see this type of trend, the experts all come out and start telling you that that is the end of the boom. And it is all going to start going pear-shaped from next year. And of course, we saw just then that 0.6% growth still happened in January. So still, this is a trend that can't be taken lightly, because we will probably not see this type of growth that we saw here in the total median prices in Sydney in the next 12 months, 18 months, even 24 months. Okay. But I will talk more about the forecast and what I think will happen and what my predictions are shortly. But firstly, to talk about the key considerations, what moves the needle when it comes to house prices? These are my top 7. Okay. The number 1 is supply and demand. Why supply and demand? That is economics 101. Any commodity, any goods you buy or sell, supply and demand is the most important thing. Okay. If you have no demand, forget about house price increases in any commodity. Okay. So secondhand cars, if I can use that as an example, in the through COVID, their prices went through the roof. Why? Because there were no cars. The supply was down and the demand was high. Why was the demand high for secondhand cars? Because new cars were not coming. They're not getting manufactured. Okay. The supply chain dwindled through COVID. So these type of factors impact not just house prices, but every type of commodity. So number 1, supply and demand is absolutely key. Demand substantially increased for house and land in the past 12 to 15 months, substantially increased. Okay. And the supply was short. The supply was really short. And one of the reasons why you saw this downward trend here in the last quarter of last year is that supply actually picked up. Supply picked up significantly, and people listed their properties thinking, oh, they're going to miss the boom. And that has actually caused the prices to subside. So this equation, keep in mind, is extremely, extremely important as we go through our slides. That's my number 1. Number 2, very closely aligned to this, is the fact that interest rates are at record lows. Yes, there is a lot of news at the moment in terms of interest rates going up. Will it go up? It can't go down any further. And the next one, the affordability is very important. Okay, they're linked. The APRA regulation, they're all linked. They're very, very closely linked. So firstly, interest rates. There is a lot of media. Yesterday, the RBA, so first Tuesday, 2:30 of the first Tuesday of every month, okay, you get a Reserve Bank announcement on the interest rates. And everybody sort of hangs out for that to see what will happen. Well, of course, it hasn't gone up yesterday, right? And the cash rate, it's called the cash rate. So the cash rate is at 0.1%, 0.1%, not 1%, 0.1%. So that is a record low. I never thought I would see that type of cash rate in my lifetime. What drives interest rates more than anything else is inflation. A big factor in inflation is the wages growth, okay? So there are lots of other factors. Some people call it CPI, it's another economic term for inflation. The type of factors that causes inflation to go up, just for everybody's knowledge, are things like wages growth, are things like petrol prices, which we all know is through the roof at the moment, is your essential commodities, your fruits and vegetables and so on, milk and bread and all that type of stuff, but also rentals, okay, rentals. So we do know that there is wages pressure slowly coming to bear. We do know that other commodities like petrol prices, fruits and vegetables, because of the supply chain, because of the freight costs, because of all other things caused partly by COVID, is going up. Raw materials prices are going up. So all of these things are causing inflation to actually tick up. Government wants, Reserve Bank wants inflation to be in the 2 to 3% area. In the US, we align ourselves very closely with the US. In the US, inflation has gone up to 7%. Australia's inflation for the last 12 months is now at 3%. It was well below 2% throughout COVID. UK's inflation rate is now 5%. So these factors, plus the wages pressure that is going to come, because you've all heard it, and I'll come to unemployment in a minute, but you've all heard it. One of the things that causes wages pressure is unemployment. Well, unemployment figures that have just come out is 4.2%. 4.2% is the lowest I remember for quite a long time. Okay, pre-COVID, we were above 4.9. Reserve Bank thought that it might go to 12 post-COVID because of all of the issues we're going to have with COVID. It never reached that. We went up to 8%. We came down again. We came down rather quickly. Okay, so unemployment is in a very, very good place at 4.2%. But what will it cause? It will cause wages pressure. So wages and inflation will cause interest rates ultimately to go up. I am predicting that in the second half of this year, the Reserve Bank is not going to be able to resist increasing interest rates. And I'm expecting 0.25% increases in interest rates in the second half of this year. Okay. I have been saying this for those that have been listening to me for the last 6 months. I have been saying the same thing for the last 6 months. But all of the other economists have only started saying this since December. Okay. And still there's mixed feelings there. Only half of them are actually saying it. Now, it's only because these things will happen and you can't avoid that. EPRA regulation, very important. Okay. EPRA have just tightened the screws in the last 3 months to take some of the heat off the market. What have they done? They've used the buffer rate that they use to work out your ability to pay your loans when you go and apply for a loan from 2.5% to 3%, which means if your variable rate is at 3%, the bank will look at your ability to pay at 6%. They'll add 3% buffer. In case rates go up to 6%, they want to make sure, as a very prudent regulator in the world, one of the most prudent regulators in the world, they want to make sure that there won't be a collapse in the banking loan book. Keep in mind that the banking loan book makes up 50% of the balance sheet of a bank. So if a bank has a balance sheet of $800 billion, as most of our big four have, then $400 billion of that, half of the bank's assets are actually residential mortgages. Okay, it's a big number. It's a number that EPRA is concerned about. That ratio of a major bank's percentage of residential mortgages is the highest in the world. Okay, our bank's bread and butter is residential mortgages. That is where they make significant amounts of money. So we need to watch, as a headwind, we need to watch what else EPRA will do to tighten screws. They have got a number of levers up their sleeve. They've used one of the levers just now. They will see for the next 3 or 4 or 5 months whether the heat is coming off the market. If the heat comes off the market, they might not do anything more. But this is something we need to watch very, very closely. Interest rates, okay, inflation, and EPRA regulation. These are our 3 biggest headwinds, okay? There is no headwind with Omicron or any other variant. That has not been a headwind for the last 18 months. It is not going to be a headwind going forward. Yes, some Northern Hemisphere countries are going to have subdued GDP growth. That's my next point, okay? Before I go to GDP growth, the other point I want to make is the bank's ability to lend, their appetite and policy on lending. Banks have got significant appetite to lend to this asset class, okay? And they will continue to have appetite to lend to this asset class. In my personal view, they have more appetite now than before COVID because it is riskier to lend in the commercial space. It is riskier to lend to small business because that is an area where they will have a lot of write-offs in the last 12 months, that has been the area of exposure, not residential mortgages. Okay, so more appetite to shift their lending to residential mortgages. So that is not going to be an issue. The banks are flushed with money at the moment. They will continue to be competitive in the lending area. GDP growth, we are in a good place again. Our federal government, our state government, they have done an amazing job at controlling unemployment and GDP. It's all the incentives. You know all about the JobKeeper, JobSeeker. I'm not going to go through all of that again. But all the incentives, and more particularly the next point, government spending, infrastructure, and incentives that they have provided our state government and federal government has kept these two figures in check, okay? They have made sure that these two figures remained healthy. And that is important for any economy. That is a key driver for price movements in the property market. Because if you have high unemployment and your economy does not grow, guess what happens? It's going to have a direct impact on the housing market, okay? So I'll move on to the sixth point here, which is delinquencies and write-offs. So I just already told you half of a bank's assets are actually mortgages. Now, if the bank starts having high level of delinquencies in the mortgage book, and what I mean by that is if you don't pay your mortgage for 1 month, 2 months, 3 months, 3 months is the limit, okay? The banks have what they call a watch list. And then once you get to 3 months, it becomes what the bank calls a worry list. You're on the bank's worry list. And the next thing that will happen is you'll get a letter that says, we will possess your house and we're going to do a mortgagee in possession sale. Well, I can tell you there are very, very, very few delinquencies, very few residential loan write-offs. There is, I don't know how many of you have seen a mortgagee in possession sale in the last 5 years. They are very few and far between. But in this current market, if you have a mortgagee in possession sale, guess what? It's going to probably make a record price for the street. Okay, so this is not something we need to be worried about, is my point. In a bad market, when we've got negative GDP, we've got a recession, unemployment shoots through the roof, as we had in the 80s, okay, unemployment went to 7.5% and stayed there for a long time. We had the last, in the mid 80s is when we last had a major recession, okay? That time, and I was around, there were a lot of mortgage in possession. So not an issue to worry about right now, but it is, that's why it's number 6, and it can have an impact on price movements. So global factors. I'm not going to go through all of these, but they do have a bearing. They do have a bearing indirectly on our property prices. One of the main things we have seen is foreign buyers, okay, and I haven't put that there, but foreign buyers or non-residents as well, impacting our local market. We'll talk a bit more about that in a minute. Okay, most important thing, and with this, most of my talk today is Sydney-centric. The most important thing you all need to know is what is about to happen, what is currently happening to our Sydney market, but also what is going to happen to our city that we live in. Okay, none of these are my numbers. These numbers are actually from the New South Wales Treasury. Okay, now by 2036, we're going to have 6 million people here. By 2054, we're going to have 8 million people in our city. I'm just talking about Sydney. To cater for this type of growth, we're going to need almost 40,000 dwellings per year. Okay, that's a lot of homes. A lot of homes. And what you are all witnessing at the moment is what I call twice in 100-year transformation of our city. Schools are getting upgraded, new schools are being built, hospitals are getting upgraded, new hospitals are getting built. We've got metros, train lines, all kinds of transport development, tunnels being dug everywhere. There is a huge amount of transport work that is going on. And our infrastructure projects in the city, mind you, is more than the rest of Australia added together. If you add up all the infrastructure, including our airport, our Astropolis, and everything else that's going on in our city, if you add up all the infrastructure projects that are being done outside of New South Wales, they don't add up to what we have here for the next 5 years. Hopefully that makes sense. That is what is keeping our GDP very strong. That is what's keeping our unemployment really well. And this is going to continue all the way to 2036 and 2054. Okay? Very important to note. The other important thing to note, and I'm going to talk more about that in a minute, is that this type of number of dwellings that have been required were not required, to be perfectly honest, in the last 15 months, and 15 to 20 months. And the reason for that is that migration pretty much stopped. Most of this growth is coming from migration. Okay, migration pretty much stopped. Students went back home. There's tens of thousands of students who did not come here, okay, during that period. And that actually made the apartment market suffer in a big way, okay? And some of those figures you saw before was because of that. I'll talk more about that now. So let's focus a little bit on where the so-called banks, economists are at the moment with future price growth, 2022, 2023. And I will caution you, okay, because these same banks in mid-2020, okay, mid-2020, the same banks had predicted a 20 to 25% fall in housing prices in 2021. So the turnaround was, instead of being minus 20, we were plus 24. So that's a 44% on average turnaround, that how far they got it wrong. So for what it's worth, this is the figures. 2022 ANZ up and then 4% down in 23. CBA 6% up and then 12% down in 2023. CBA is the one that predicted a 25% fall in 2021. Okay, NAB 5.4 up. They haven't been game enough to put the 23 figure. Westpac 6% up and 6% down. Okay, so Westpac in 2 years are saying we're going to be neutral. A bit more analysis to paralysis on the next slide. And this is from SQM. I do read a lot on SQM. I think they're a good, strong research unit. And generally, they are better than banks. They have actually put a few scenarios here. Scenario A1, base case. Scenario 2, Scenario 3, Scenario 4. And all of it is based on where inflation is going to go, where interest rates are going to go, and APRA. So the three things that I talked about before as the key headwinds we've got to watch, that's what their scenarios are actually based on. Okay, so for Sydney, so here's where we have come from. Okay, here's base case. Basically, cash rate remains unchanged. Headline inflation 3 to 5%, and further APRA action by June. So that's a -2 to +4. A pretty big range. And then it goes on. Okay, your best scenario is here. Cash remained unchanged. Inflation is within a reasonable target range, and APRA takes no action. And QE scale back. Okay, I don't have time to explain QE today to all of you, but maybe for an education session later on. It is more complex. It goes into the bond markets and some of the incentives that the Reserve Bank provided banks throughout the COVID period. But that's probably their best scenario. Okay, so this is 22. So listen, there's a lot of variance there. There is a lot of, obviously, scenarios are based on certain assumptions. And are any of these possible for the next 12 months? Absolutely, they are possible. Absolutely, they are possible. And I would probably be more in this area here of +3 to +8. Keep in mind, again, I am talking about every single type of dwelling, every single suburb, median price growth. This is how the numbers are done. Okay, it's a median price growth and across every single type of product. Okay. So with that backdrop, I am now going to talk about the Sydney property market in the next 6 to 24 months. And I call it the perfect storm for apartments. Keep in mind, I'm calling it, emphasis here, perfect storm for apartments. Okay. Why? Firstly, we're going to continue with historical low interest rates. So when I said to you before that we're going to see 2.25% increases in the second half of this year, 2.25% increases are not going to move the needle when it comes to the type of properties that I am going to talk about shortly. Okay. Yes, it will move the needle in your $2 million, $3 million, $4 million properties, but not in the apartment market and not in the type of properties I'm going to talk to you about. Now, demand was my number one factor, if you remember, that moves the needle. Where is this demand going to come from? For apartments, okay? For apartments. Migration, absolutely, okay? We are going to see, borders have only opened to a few countries so far, but that's going to increase. Now, migration, a normal migration year for Sydney is about 95,000 people. And for that, you need 38,000 dwellings. I expect somewhere between 100 to 150,000 people to arrive in Sydney in the next 12 months. Whether they are from migrants, whether they are returning expats and students, whether they are other people that are looking for properties here. Okay, so that demand is also going to come from these FIRB approvals, which is, if you don't understand what that means, is Foreign Investment Review Board approvals. So what that means is that if you're a non-resident living in anywhere in Asia or UK or US, you can apply to purchase a property here. And that is how a lot of Chinese buyers actually bought properties here that were pre-FIRB approved, particularly in apartment blocks all over Australia, particularly in the Eastern Seaboard, Melbourne, Sydney, Gold Coast, etc. You will be surprised that the FIRB approvals post-COVID has gone through the roof. Some of the countries which I did not expect a lot of FIRB applications coming from are countries like Canada and US. So people are getting fed up of their countries. They want to move to somewhere like Australia. And these type of things are going to actually cause the demand to go through the roof. Already we are seeing that, we are witnessing that, and we're witnessing more in the higher end of the market where expats are buying and where some of these investors from overseas and FIRB buyers, they are pushing those prices up, okay? So if you actually go and Google the high-end prestige property market, which is your property market above the $5 million to $25 million, Sydney performed better than any city in the world in the last 12 months. Don't take my word for it. Please go and Google the prestige property market. The highest price increase in the prestige property market in any city in the world was Sydney. Guess what? That is going to filter all the way down across our market. So our property market is going to continue to see increases in prices, okay? Supply will continue to become lower than demand. Now, why will supply dwindle? Because the demand is going to be so high that supply is going to will not be enough. Now, some of you might be thinking, well, we've got plenty of apartments and there is high vacancy rates in places like Parramatta, in Zetland, parts of Kellyville, and a number of other suburbs. There's probably about 5 or 6 suburbs in Sydney where you can say that, and the CBD of Sydney, actually. So in those places, yes, there is a lot of supply. Will that supply get absorbed really quickly? Absolutely. Okay, that supply is there because we did not have the expats coming, the migration happening, and the students. That's why the supply is there. It takes 3 years to build an apartment block. By the time you get your DA approved, by the time you start the project, by the time you finish the project, 3 years has elapsed. In next 2 years, this year and next year, we could be seeing 250,000 people coming into our city. Any small amount of oversupply now is going to get absorbed in the next 3 or 4 months. Mark my word. Okay. Then you've got our government. You've already seen our infrastructure spend. I won't dwell on that. We will continue to fund our infrastructure in this state. We have a very strong balance sheet. We have a well-run government. Low unemployment will continue in our city, and there'll be huge infrastructure spend. Our GDP will continue to grow. Consumer confidence and business confidence. Listen, this came down way down during COVID. It is way back up again, okay? And it will stay up. People did not lose their jobs. They've got their jobs back, okay? So your confidence levels are very high at the moment. So why should you buy an apartment now? Why now? Okay. So what has happened is there's a big gap that has developed between the house prices and the apartment prices, a huge gap. In my last 40 years in Sydney, I have not seen this big a gap develop between apartment prices and house prices. And I've just gone through the factors why apartments suffered during this last 12 to 18 months and why house prices went up. Partly it was the affordability that caused people to move into a lot of the house and land packages that we in Nivas sold in the last 18 months were people who were living in apartments in places like Homebush, in Wentworthville, in Westmead, in all of those suburbs, okay? They were living in apartments. And now where they're moving to a house and land, or they're buying a house. So what does that do to the apartment market? It does not get filled up. So rentals came down, and that apartment market. So that is something to keep on the back of your mind. The second thing is that this gap is going to close. Sorry, I haven't changed my slide. This is from December. So this gap is starting to close already, and this is this year. So between now and June, you will find that the price gap is going to change significantly, okay? Not because house prices are going to come down. The house prices will go up still maybe 2-3% in the next 6 months, but the apartment prices are going to go up much more, okay? Much more. My prediction for apartment prices just in 2022 is 20% up. You might think I'm stupid, that's okay. But I predicted a 20% up in house prices in July of 2020 when the rest of the market were actually saying a 20% fall, okay? And that is backed by good reasons. Now, I have been writing articles in the newspapers talking about why apartment prices are gonna go up and why this gap is gonna start to close starting from now. Okay, it's already starting. We are seeing already that your big developers like your Meritons and your Mervicks, they've already upped their prices by about 2, 3, 4, 5% in the last 2 months. Okay, we sell for them. We have their figures, prices going up. Some of the discounts that are being given, 5, 10, 15, 20,000, they're being taken out now. Okay, incentives are going away. Why? People are coming back. This is the start of the boom. Another big factor is the large percent of population will now not be able to afford homes. Homes are not for everybody. If you go to the big cities, okay, if you go to the big cities where house prices are really high, and it can be anywhere from Hong Kong, Singapore, Delhi, Mumbai, New York, London, all of those places. Not many people live in homes, okay? The next trend that is gonna start here is your dream of having the quarter acre block will no longer be affordable to a large percentage of our population. Guess what? Fear of missing out is one factor. They're going to move into apartments. It is going to happen. So more in vogue is going to be apartments. Okay. Now, what I'm suggesting to all my listeners today very strongly is, and this is sorry to use a banking and a global markets term, is to gear with price arbitrage. Go and buy an apartment today at today's price, pay 10% deposit. And if it doesn't settle for the next 12 to 18 months, you buy at today's price, you buy the right property in the right place, okay? And you watch the property price grow by only paying 10%. That is called gearing, and we've got a price arbitrage. While this gap closes over the next 12 to 18 months, you sit there and watch your price grow, and you win the market just by paying 10%. There is no better way of making money than doing what I'm suggesting here in the property market. If you are listening and you have parents who have equity in their home and they're not using that equity, let's say everybody's house prices have gone up. So, or if you have your own home and you're sitting on equity, if you've got 400, 500, 600,000 equity in your house and you're not using it, then that is equity that you are wasting. This is a perfect opportunity for you to say, I'll take 50,000 out of that or 60,000 out of that equity, and I'm going to buy another investment property for myself and gear up for this price arbitrage. Or I'm going to help my kids to actually get into the property market now. They're going to have to work it out how they borrow and pay in 18 months' time. Okay, so that is very important. This is a great opportunity for you to take advantage of. This type of price gap doesn't happen every year. I haven't seen it in 40 years. I am telling you, this gap is going to close. It's going to close quickly, and you need to take advantage of it. Media is now finally picking up on this. Okay, this is December. I have seen 3 more articles in January, didn't put all of them here. House and unit price gap reaches record levels. Sydney's gap was the nation's widest, with houses 523,000 more expensive than apartments. Never happened before. This gap is going to close. Okay, all the other media is now picking up on this. Apartment prices are set to bounce as house prices become too expensive. September to last year, Financial Review. Domain, Sydney prices gaining momentum as affordability bites. Domain, August 8. Insider, Business Insider, apartment prices begin to turn around. In the property clock for apartments, this is the start of the recovery. Okay, this is the start of the recovery, and it will take a good 12 months to get to the peak. Could be 18 months. Okay, and the next 12 to 18 months is when this market is going to peak. What you saw happen last year with your house and land market, you're going to see in the next 12 to 18 months with the apartment market. I'll talk a little bit, conscious of time, but I'll talk very quickly about the rental market, because I have been talking about the rental market now for the last 4 or 5 months. Suddenly now, the media is now coming out and telling you what I have been saying for the last 5 or 6 months. There is going to be, so this is sort of pre-COVID and then post-COVID. So rentals fell through COVID, migration stopped, and all of that sort of demand went down for rental properties. And then now house rentals are going through the roof. Apartments are starting to see that as well. But there's a lag effect, okay? There's a lag effect. What will happen is, if any of you know anyone that is trying to rent a house at the moment, not apartments, but house at the moment, you will know that it is almost impossible to get a rental property. Rents have soared at the fastest rate since 2000 because of the squeeze, okay? And this is just the beginning. So what you're going to see in the next 6 to 12 months is an acute shortage of properties in the market, and the demand and the demand's going to go through the roof. Rentals are going to go through the roof. Rentals go through the roof. You know what happens. Okay. There is going to be an acute shortage for every house that is listed for rent. And I know there's some agents listening to me today. For every house that's put on rent in the Hillshire at the moment, and I'm sure most suburbs in Sydney councils are the same, there is at least 30 or 40 people on the first open looking. There's people going to the agents and saying, I will offer $50 more, please give it to me. This is happening right now and today, and that is going to push rental market through the roof. At the moment, our vacancy rate in Sydney is 2.6%. We peaked here at 4, we're at 2.6. I put a Brisbane comparison here. They peaked at around 4. They're now down to 1.3. Why is Brisbane market so low? And this is the whole of Southeast Queensland is so low. The vacancy is so low. Okay. It is low in Brisbane, Southeast Queensland, because they have had massive amount of internal migration. They've had people going from Victoria, and they've had a lot of people going from Sydney and New South Wales as well. Okay. People are selling out their houses. They are moving up north. That is happening. It is causing acute shortages in property there. They were not prepared for this. 65,000 people moved to Brisbane in a short space of time, like 10 months. They haven't witnessed this before. So there's an acute shortage of properties. Our graph is going to come down. By mid to the third quarter, we're going to go to 1%. Mark my word, we're going to go to 1%. That is chronic levels. 1% vacancy is chronic levels. Okay. This bottom part is just showing you that we are not a one property market in this city. Different parts of Sydney are having different, dealing with different vacancy rates. This is the average for the whole city across all types of properties. Okay. Now, so this is important. You've got to watch this closely in terms of how we're going to go. So very simple graph. Everybody will understand this. We're going to continue to see massive economic growth. We're going to see jobs growth. I did not think unemployment is going to go to 4.2 so quickly. We're going to see wages growth. We're going to see population growth. Increased rental and buyer demand results in one thing, increase in property values. Okay. So very, very important to understand this simple graph. I did not put any complicated graphs, hopefully today, so you can all understand it. Now, very quickly, again, I want to talk about when you're buying a property, on the backdrop of everything I've said so far, you should not go and buy a property somewhere blindly. There's rhyme and reason as to why location is so important. Where is infrastructure happening? Where are roads going in metro, hospitals, schools, TAFE, colleges, shopping centers? Where is all this happening? Where's the investments coming in your local area? Okay. What is happening with population growth? I'll use a very simple example, Marsden Park. Those of you who know Marsden Park will know that in the last 3 years, the growth there has been massive. Forget 20%, forget 25%. We're talking 60, 70%, okay? We're talking massive growth in a suburb like that. Why? You've got all the big companies investing there. Population has grown there. So all of these things, you got to watch supply, demand, population growth, the demographics, what type of people are actually going there, okay? Land is running out. All of these factors are very important when you're looking at investments. Second most important thing, it's not just location. As most agents will tell you, price. Price is absolutely key. You must never pay a premium for a property. I'll say that again. You must never pay a premium for a property as an investor, or even if you're buying your first home. You've got to be price sensitive, okay? We have seen a lot of cases where people paid $1 million, $950,000 in Wentworth Point to buy a 2-bedroom apartment. And they're still waiting for the price to go up for the last 4 years. They bought off the plan, they paid a premium, they paid too much for the property. We will never here in my seminars recommend you pay a premium for a property. Timing I've talked about, it is very important. Timing, arbitrage, opportunity right now for apartments is amazing. Very important also, who is the developer and builder? Extremely important, okay? So very quickly, some economic facts. New South Wales, and I'm just talking not Australia, GDP of New South Wales is actually bigger than, this is our economic, GDP is our economic, okay, gross domestic product, is bigger than these countries, Malaysia, Singapore, Hong Kong. The Greater Western Sydney, okay, so when we talk about Greater Western Sydney, it includes all of the Parramatta, Penrith, northwest of Sydney. There's a big part of Greater Western Sydney. Half of Sydney's population live in Greater Western Sydney. That is the third largest economy in Australia, okay? There is no better place to invest today with all of the things I've told you than in the Greater Western Sydney area. Okay, where, but it's very important where. Northwest Precinct will become bigger than Canberra in 8 years. Badgerys Creek Airport's coming. Western Sydney Metropolis is coming. You can read all of the other points here. Okay, very important. This graph is going to go through the roof. In this period of time, this graph is going through the roof in terms of population growth. Article I talked about briefly, I'll mention here. I wrote an article in the largest Indian newspaper in Australia called Indus Age. And the long and short of this article is very simple. You got to pick a suburb where there is significant infrastructure spend, number one. Pick a suburb where there's the significant house and apartment price differential. pick a suburb where the price range is 550 to 600 for 2-bedroom. In my article, I have said that you can go up to 750, 800, but in the right suburb. Okay, you got to pick a reputed developer builder. Absolutely key. Now I will stop there because I want Krish now from our team to actually showcase a project for you that we think ticks for us. It ticks all the boxes, And before I actually pass on to Krish, I talked about don't pay a premium for a property, and what we say is you buy wholesale if you can, not retail. Okay. Now there are very few opportunities that our buyers get where you can say that you are buying at a pre-launch. A pre-launch actually means that you are buying before the builder actually gets their finance. There's a certain number of properties they want to sell in a development before it goes and hits the big market. We have been given exclusive rights for a short period of time to sell in this complex in Blacktown at what we call a pre-launch opportunity for our buyers. So you're buying at today's price. Keep in mind, you're buying at today's price for a product that will go on for a while. And I'll hand over to Krish now.
Perfect. Thanks so much. Guys, my name is Chris from the Nivas sales team. I would like to introduce you to Evoke in Blacktown. Now, as Sachin mentioned, this project is exceptionally well priced. In terms of location, it's a 5-minute walk to basically everything. So your train station is 5 minutes away. The shopping center is 5 minutes away. University is 10 minutes walk away. So it's in a very, very good spot, but I'll get into that in a bit more detail. It's a lovely facade that you guys can see there as well. So it's a very, very good looking building too. Now, if we move on to the next slide, I want to give you a bit of insight first and foremost about the developer. Now, at Nivas, we are extremely particular when it comes to who we work with. We conduct checks such as checks on the Building Association, fair trading. We do strata reports on previous builds that they've done as well to ensure that we are dealing with a reputed developer. And if one of those boxes are not ticked, we walk away. With regard to Jasara, they have ticked each and every single box. Now, 25-year history. They're an industry leader in high rises and low rise developments. They've built multiple projects in the past. They've done some work for the New South Wales government as well in terms of building some buildings for them. So they have a heap of experience. They have more projects coming up, and they're an exceptional developer builder. Now, if we can move across to the next one. This is just a few examples basically of where they built. So some of you might have seen on Princess Highway, the Wave, that building on the top right. It's a really nice looking building there, which completed about 2 years ago. They've done another one, Villa Del Mar, on the bottom left-hand side, which is in Rouse Hill. They've done one in Kellyville. So all over Sydney, basically, they've built. And they built with a very high quality finishes as well, which we'll get into a bit more detail as well in a moment. Now, location-wise, guys, Evoke is where you obviously can see it there. West Point Shopping Centre is a 5-minute walk. The bus stop, train station, again, 5 minutes walk, if that. You've got Australian Catholic University, 10 minutes walk away. You've got, I guess, one of the key things is your walking distance to everything. But one of the most important things I wanted to highlight here, the trains, if you catch a train from Blacktown to the CBD, on a fast train, it'll take you just over 30 minutes, right? If you look at any other suburb in that vicinity, which takes you 30 minutes to the CBD on a fast train, if you can get anywhere at the prices that we're offering, basically, 2 bedrooms at about the 550,000 mark, 1 bed at 435. So I'll get into that in more detail. Plus the added incentives we've got on top. There is nowhere else in Sydney where you can find a property that cheap, that close to all of these amenities, and also within 35 minutes to the city on a fast train. So it ticks every single box. You've obviously got the shopping center, which is huge. You've got everything there. So amazing location, guys. Now, just a little bit more around what's going on. So you've basically got you've got transport, education, hospital, shopping center, amusement parks, everything within a very short walking distance, not walking distance, but a very short distance away. In terms of connectivity, so basically you're going to be getting connectivity taking you out to obviously the Aerotropolis. So they want to basically make Sydney have, I guess, not just a CBD, but smaller cities all surrounding. So you're going to have the Aerotropolis in around Austral, Leppington, that area, which is going to have very easy connectivity to Blacktown. You're also going to have, so basically they want to link up all of these cities to make it easily sort of accessible. So in a nutshell, it's going to be well connected. In fact, at the price point, I would say it's probably one of the most well-connected suburbs in Sydney or in Western Sydney. That's including Parramatta, right? Now, you can get anywhere from Blacktown, whether you're using the M7, which is close by, which can get you to Southwest, M2, which can get you to the Northwest, even the city, for instance. So you've got good driving connectivity, good buses, good trains. You've got everything a stone's throw away. So it's an exceptional suburb when it comes to connectivity. Now, in terms of the finishes, guys, you've got floorboards, as you can see here, 2.7 meter ceilings, ducted air conditioning, stone bench tops, downlights. So all of the high-end amenities that you'd expect in a high-end apartment is what you are getting in Blacktown. We do have a completed display suite that I can take anybody through any time to show you exactly what the finishes are like. But in all honesty, guys, they're second to none. I mean, if you walk into the main bathrooms, honestly, it's like you're going into a 6-star hotel. This picture doesn't do it justice. It is so nicely built. It's above and beyond anything else in Blacktown. And I've seen a lot in Blacktown, and these guys are a cut above the rest, honestly. So if we just click the next, in the building, guys, you're not going to have any amenities such as pools, gyms, saunas, all that stuff that, you know, a lot of people don't use and yet pay money for strata. So all you're going to get is your rooftop, which you see here, which is a really nice rooftop. You're going to have 2 lifts in the building as well. And basically, actually, no, there'll be 3 lifts in the building. I apologize. And that's basically it. So it's going to be well finished, very well made, not many amenities. So it keeps the strata cost nice and in check as well. And yeah, it's on a lovely quiet street too, surrounded by homes, which is lovely. Now, if we move across to the next. Now, this is just a synopsis of stage 2. Now, as Sachin mentioned, we are in the pre-sales phase at the moment. What pre-sales means is we basically got 2.5 weeks at prices which are well below market. So what I'm showing you here, 1 bedroom from 435, 2 bedroom from 560, 3 bedroom from 670. There are going to be additional incentives above and beyond that, right? Above and beyond that, bringing that price lower. I'm in discussions with the developer at the moment. Sachin and I are in discussions at the moment to try and get the best incentives possible. But rest assured, those prices will be coming even further down. Now, if you look at comparable apartments within the same vicinity as this, you're starting from around the sort of 580 mark. And that's because also everything else, also all the apartments in this particular project, the average size is about 82 square meters internal for a 2-bedroom. So it's bigger than anything else surrounding as well. So on a $1 per square meter rate, it is exceptional value, exceptional. We have a quota of 15 sales that we have to get for this pre-sales period. They're priced extremely aggressively. What I'm doing at the moment is taking expression of interest forms where you pay a small deposit, which is fully refundable. As soon as I get the official floor plans and everything, this is how early in the piece we are, guys. We're getting first dibs at this before any other agent. So when we do get this, as soon as we get these plans in the next few days, whoever has deposited gets the plans first, gets to choose what they want, and basically go from there. Now, what'll happen after that point is once we've already sold our 15, it's going to go to the open market, right? Once it goes to the open market, it's going to be basically selling through other agents. The pricing's all going to go up. Those incentives that they had are all going to disappear for the simple reason, once they've hit their quota, their pre-sales quota, right? They've received the money they need to obviously satisfy the funding requirements and whatnot. Then they don't care at that point. They'll increase the prices and they'll just let it sort of, just tick away as per normal. So right now we are in an amazing opportunity, an amazing time where you are buying significantly under market compared to the rest of the competition. Look at real estate, look at everything to compare. And in terms of quality and in terms of the developer, nothing touches Jasara in the area. So in a nutshell, this is an amazing project. You've got about 20 towards the end of next year. You'll be looking at completion around December. Construction is right about to kick off. And yeah, guys, look, it's amazing. I urge you to come and have a chat to whoever has invited you, to come and have a chat to myself or anybody, and we can take you through it and yeah, show you everything that there is to know about it. It's an exceptional offer, guys. Now, 2 more projects that we are focusing on as well. Now, one is Schofields, whereby we have 2-bedroom apartments there, and again, massive. So there are some 88 square meter internal apartments, which are under 600,000 as well, which are well under the market price in Schofields. So the average price roughly for a brand new 2-bedroom would be about around the 600 mark. We're starting from 560, plus we have additional incentives above and beyond that. Plus the developer is Binar Group, who are exceptional as well. We've done a lot of research on them. We've sold a lot through them as well. So that's one, which is again in that 550 to 600 mark. The next one down is Castle Hill. Castle Hill, guys, we have just launched. It is a 2-minute walk to the Showground Metro, 2-minute walk to the new entertainment precinct, which is up and coming there. It is the best value project in the entire Castle Hill suburb. Nothing touches it. If you look at other projects like Chateau and all that, they're starting from the 800s. We are starting from 760 for our 2 bedrooms, plus incentives on top of that. So when we focus on projects, guys, as Sachin mentioned, I'd like to reiterate, key thing, good developer, best developer, we need to deal with the best developers, one. Secondly, pricing needs to be under market so that you are making equity from day one. That's the idea of this whole thing. And above and beyond that, key suburbs with a lot of infrastructure that tick the boxes, that are going to be attracting people as they arrive from overseas, and also net local migration as well, whether that be for rental or buying. And we are already seeing that growth experience happening right now. So please, guys, if you have any questions, call myself, call Sachin, call who invited you here. We'll put all our details up later. And yeah, we'll walk you through it, guys. It's very exciting, and it's honestly an opportune time to make some capital gains. Now, guys, this is the Ashford in Castle Hill, just to show you what the facade looks like. So very, very nicely built. Daycorp is the developer. So they're the 3rd largest builder developer in Australia. Their level of quality and finishes, again, are just second to none. I'll go through it in more detail with you. But if you want me to have a chat to you, yeah, as I mentioned, call me, email me anytime.
Thanks, Krish. Sorry, before we take questions, a couple of concluding comments from me. So just so everybody is aware, if you're thinking we are pushing 1 or 2 or 3 projects that is on our books, that is definitely not the case. We have over 25 projects in Sydney in our books. The reason why we select the ones that make sense to us is the ones that we would buy ourselves. And if we are not going to buy something ourselves, then we walk away from those. They are secondary to us. If somebody wants to buy a Meriton apartment in Parramatta for $1.2 million, yes, we can sell it to you. We can sell any Meriton to you in Australia. But the reason why we don't concentrate on those projects is we value pick what is best for our investors and our buyers. And that's why we are showcasing what we are showcasing, just so you understand. Now, soon you will be saying, there won't be, property is a long-term game. So soon you'll be, in 2 or 3 years' time, you'll be saying, well, I bought an apartment in Blacktown for under 600,000. That 6-figure in 2-bedroom apartments is going to happen rather quickly. It's months. It's not years. It's months. Okay, you won't be able to get this price again. And just to give you a quick comparison, if you're looking at Parramatta, not 82 square meters, 73, 74, 75 square meter 2-bedroom apartments are costing above 760. Okay, so $200,000 more. You are literally a few minutes on the train, and you are paying those sort of prices. So there is nothing in Sydney at this price point. Okay, so if you're buying in Blacktown, if you're buying in Schofield, if you're buying in these suburbs at today's price for a future development, you cannot go wrong. The prices are not coming down. The prices are actually going to go up and go up a lot. That gap is going to, Blacktown's already become almost $1 million suburb for houses. Try buying any house there for under $1 million. I challenge you. Go to Mount Druitt, which has a stigma attached to it. In Mount Druitt, you're not going to see these prices. Okay, I cannot overemphasize, but this is a grand opportunity for you to buy a quality product pre-sale at that sort of price. Okay, in an amazing location which ticks all the boxes, whether it comes to transport, hospital, tertiary education, supermarket, facilities, all of the boxes get ticked in a suburb like Blacktown. Okay, now, I always say this at the end of my talks for those who have listened to me before. Investment is a long-term game. Do not be surprised if we're 2022. Don't be surprised by 2030, in 8 years' time, there will be no two-bedroom, brand new property in Sydney under $1 million. Okay? I remember when Blacktown, 7 years ago, I was looking in Blacktown to buy a two-bedroom brand new apartment, and the prices were almost half of what it is today. Almost half, okay? Slightly more than half, okay? So don't be fooled, okay? In 7, 8 years' time, there is every opportunity that your property is going to go up in value. Also, I will say to you that any of you who are earning good money, who have got equity and you're not using it, use this opportunity to grow your portfolio. For first home buyers, this is a perfect opportunity. You're in the property market just by paying 10%. For people who already own a property, they must have some equity. You can park some money here and make money. Okay, it's a no-brainer. Australians are the wealthiest people per capita in the world. We've gone past Switzerland over a year ago, and that is only because of one fact, because we invest in property, and property values go up, and property values will continue to go up in our city. If you want one-on-one expert advice, I am available. Krish is available. Our other team members are available. We do not charge you. We do not do a sales pitch with you. We are here to help you accumulate a property portfolio and get the best value properties in your portfolio. Some of you who are on a good salary, combined incomes of 150, 200,000, there is absolutely no reason why by the time you retire, you should not have double-digit properties in your portfolio. Okay, and I am here to help you to generate wealth through property. I'll stop there and take questions. Sorry, there's some phone numbers and contact details there, but whoever's invited you today, obviously contact them. We urge you to consider this project because you are buying at wholesale prices in a fantastic location. Thank you.
Okay, so we have a few questions from Ujwal, which I can see. Okay, so Ujwal, first question: why people say don't invest in flats? Because of the high buy price, less appreciation and strata, etc. First question.
Ujwal, thanks for your question. And less appreciation is only a short-term phenomena. Okay, so less appreciation, and I don't know, Ujwal, how long you have been in Sydney. I can talk
just over a year and a half.
Just over a year and a half. Okay, that is the probably the period where you've seen the worst performance with apartments.
Right.
Okay. Okay. But that's okay, Ujwal. That's okay. We all learn from our experience. And I can tell you, I can give you a number of examples where I have bought an off-the-plan apartment. And on the day of settlement, I have made 120,000 profit and only paid 10%. So I can give you more than one example of that from my own personal experience. But there are a number of other people who can give you experiences where they have made more than 200,000 by the time they settled on an off-the-plan property. The key is you've got to buy at the right price, at the right timing. Okay. There are lots of other examples that Christian and I can share with you. And Christian was working for the largest agent selling apartments in Wentworth Point Roads area. Yeah. And he can share with you that people paid $1 million for 2-bedroom apartments, and the prices actually, the valuations on them actually came out at $850. And they wanted to get their money back, and we couldn't get their money back. Okay.
One bedroom.
Horror stories out there. So, which is why we are not going to suggest to you, any of you listening today, that you should go and buy a $1.2 million apartment in Rhodes. No, absolutely not. Will it grow in value? Of course it will over time. You need to value pick where you're going to make most of the money. You cannot buy 2-bedroom apartments in Sydney anywhere under $550. Even in Penrith, go and check the prices in Penrith. Okay. So the reason why we make the recommendations we do is because of that. You are absolutely right, Ujjwal, that people have made significant amounts of money if they bought land, if they bought existing houses, if they bought house and land packages. In the last 18 months, they have made more money than any other class of asset, cryptos included. So the point is, right? The point is that will not be repeated. That will not be repeated. Okay. This is not, the affordability is going to strike that sector of the market more so when you get a 0.5% property interest rate increase. And if APRA tightens the screw and you get a 0.5% increase, that is where you're going to see the biggest halt in the property market. But in the apartment market, in this price range, you are not going to go wrong. Absolutely not going to go wrong. You're going to see massive growth. I am predicting 20% increase in these type of properties in 1 year, not 2 years, in 1 year.
But even if APRA actually tightens its screws, so it's, how is it that you are predicting that only house and land is going to get affected and not the flat or unit prices?
I'll give you a quick example. Okay, I'll give you a very quick example. They tighten the screw. You move the affordability, the buffer from 2.5% to 3%. Okay. Now let's say you take somebody who owns their own house and have got a mortgage of $1 million on their own house. Then they own 3 other investment properties, and those investment properties are all have mortgages on them.
Okay.
Suddenly they want to buy another property. They want to buy their 5th property. Okay. They got 3 plus 1, the house. They buy that 5th property. And what the bank does is the bank says, well, I'm going to assess all your loans across all your 5 loans at the new 6% rate. Okay. So their ability to borrow more money for their 5th property is suddenly taken a hit, hasn't it?
Yeah, yes, you're right.
Taken a hit, a bigger hit, somebody who's a first home buyer. A first home buyer says, listen, here's my facts and figures. At this, you are getting no stamp duty. You're getting a grant from the government, and you're entering the market at today's rate. It's a no-brainer. For me, it's a no-brainer.
Yeah, I think the only advantage that I see is like the first home grant is what I can see in there, but that too in the units that you are actually predicting, I think there is a cap on it, like how much grant you can get on the price of the house, right? I think it's 650K, like lower than 650K is
600. See, listen, 600,000 for a grant.
Yeah. Okay.
50K for 0 stamp duty.
Okay.
Listen, you don't buy a place. You do not invest or buy a house because you're getting a $10,000 grant.
Obviously, yes, yeah. But you look into that aspect that whatever maximum you can benefit out of the grant or whatever you can.
Of course you do. But listen, this is your point about apartments don't go up in price and it costs more and they don't appreciate. That's a myth. That's only applicable in the last 18 months. Trust me on that. Okay.
Okay.
I can tell you, Blacktown, 7 years ago, December 2014, a brand new 2-bedroom apartment was in the high 200s, and now it is 550. Okay.
So Sachin, I get your point. So what do you recommend in that sense? Like, should you actually go in and buy in Blacktown? I'm just picking up, like, because we are discussing Blacktown. I'm saying any random suburb. If you pick up any suburb, you buy something there and then you start living in that property and then wait for it to appreciate, or you actually put it on rent so that your mortgage is paid off and then you are waiting to build on that equity and you are.
Ujjwal, your question is too specific, and we can take this one offline. So
Okay.
give us a call, give Krish or myself a call,
Sure.
rather than take everybody's time.
All right. No
Because
worries, sir.
everybody's circumstances are quite unique.
Yeah.
And we can discuss your circumstances and definitely assist you. We would love to do that, to be honest.
Yep.
Sure.
I believe Raj might have been, so get back in contact with Raj and then we can have a separate chat. Yeah.
Yep, I can tee it up.
Yep.
Yeah.
Perfect.
Definitely.
Thanks, Ujjwal.
Thank you.
That's all right. So the
Thanks,
next question, what's the difference between townhouse and flats? Why are townhouses not considered a good investment? As well from Ujjwal. So yeah, that would be
We will cover your questions as well in more detail. I've got one here from Note 10 Plus.
That's Alex.
Okay.
Yep.
As a first home buyer, would you recommend going for an investment property over 600,000 and not get the 10,000 instead ground, go for a property under 600 receiving? Yeah, listen. Okay. Listen, there's, grants are just that, $10,000. Now, do you go for a grant for something under 600,000 as a first home buyer? Well, like Ujjwal just said, if you're a first home buyer, you want to get every kind of incentive you potentially can. Make sure though that you're buying in a value suburb, and that'll give you the capital growth. Capital growth is the most important thing when you're buying properties. Okay. For investors, yes, you look at return, but we do have separate sessions for return versus capital growth, and we'll invite you to those as well. But listen, it's something that we can cover off. But sorry, let me just read the question again. Yeah, for an investment property over 600, if it's an investment property, you don't get any grant. So it has to be an owner-occupied property. Okay, so I don't know whether Alex is buying for an investment, looking for an investment, or are you looking to live in the property?
Yeah, I'm assuming as a first-time buyer, you'd be living.
Well, yeah, sorry. That's the thing I'm tossing up between. And if I choose I can, like you said, I can only get the 10K grant if I am living in the property.
Correct.
Like, I'm only 22, so there's no rush for me to get into a property and live in it. But whether I should just get something cheaper and start off building my equity that way, rather than going for something expensive and living in it straight away.
Is this your first property? You're doing your first property?
My first property.
Okay.
Yeah.
Well, listen, for your first property, certainly maximize your gain. Bigger than the grant is the stamp duty. Okay, so yeah. Stamp duty on a $600,000 property will be north of 20,000. So if you save 20,000 plus in stamp duty, and you save, you get 10,000 grant at the same time. That's 30,000. If the developer is giving you another 10,000 off, that's 40,000. So you're already sort of winning. Okay. So for you, definitely, I would recommend you find a buy like this and you live in it. Live in it for 6 months. Make that your principal place of residence, your first home purchase, and take advantage of all these benefits. That would be the first thing for you. And at the end of the day, you got to take advantage of all of these things.
Okay. Thank you.
But feel free to call us if you have any other specific questions on.
Yeah, call us anytime, Alex. Yeah, if you need anything.
Thank you.
Okay.
Okay. Let's have a look. Alex. So Ujjwal will get back to you. That's fine.
Drake has got a question.
Okay.
The price difference between Telawang Village and Castle Hill, both from Daycop, reasonable.
Yeah.
Yeah, listen, it is. We can take this one offline with you, Vaughn. But buying properties, it is all about, it's horses for courses, as they say in Australia. So you've got to look at the pros and cons of every place. Tallawong Village is an amazing project. Castle Hill is an amazing project. They're two different price points. So Tallawong Village started at mid 600s and up to about early 700s in their pricing. At Castle Hill, the prices start from 760, but they go to 950 for a 2-bedroom. Okay, so it depends on the size, the floor level, the aspect. They're catering for people who are downsizing. So the 950 ones have got like a 35 square meter balcony and a large internal, like a 100 internal. It's almost like the size of a 3-bedroom apartment. So it's horses for courses. It's really, it is well priced. Tallawong Village was extremely well priced. We are very bullish about the price growth there. This one also, because competitors, you can't buy any 2-bedroom apartment in No West for under 900 in a good development. Right. And that's why we know that this has good value as well. But we can take this offline, Vaughn.
Yeah. Other thing quickly to note, Vaughn, in terms of the area, so the median price in Rouse Hill is X. Castle Hill is obviously higher. So that price differential also does come into play as well. But respectively, they both are very good value for what you get. Yeah.
Okay. One more question, maybe, if there is any. Conscious.
Ujwal has sent a question. What are the advantages of interest only or principal and interest? We will come back to you on that one.
Ujwal, very quickly. I mean, if you are actually an investor, are you talking as an investor or an owner occupier?
Buyer, not an investor.
As an owner occupier?
Yeah, as an owner occupier.
To live, yeah.
Okay. Listen, I can't give financial advice because I'm not qualified to, but I will recommend with a disclaimer. Okay, I will recommend to you, right? You should talk to a mortgage broker, but I would recommend to you as an owner occupier, go and find the lowest fixed rate you can to purchase a property. Okay, and lock it in for as long as you potentially can. And you make it interest only. Make it interest only. Okay, because that will help your cash flow. Interest rates, variable rates are not going to go down. In a falling even in a falling interest rate market, it's good to go for variable rates.
Okay.
Can't fall anymore.
Yes.
Variable rates are going to go up. If you go and take out a variable rate today and buy your own home and live there, guess what? Sometime this year, your variable rate is going to go up once and then twice. Next year again. In 2 years' time again. You don't know how much it's going to go up next year. Okay. So my advice to you is you would have more certainty to have a fixed rate. Keep it interest only if you can. There are some very good rates still out there in the mid twos. Sometimes low twos you might be able to get as well. But as I say, I'm not a financial advisor and I cannot.
No, I get it.
Otherwise, I'll get into trouble. But
don't worry, I'll not quote you anywhere.
Okay, but we're happy to talk to you outside of this meeting.
Yeah, sure. I'll get in touch with Raj how we can arrange for a discussion.
No problem.
Yeah, definitely.
Okay. Any other questions? Otherwise, we'll sign out.
Any questions, guys? No silly questions.
Thanks everyone for coming.
No such thing as a silly question. Yeah, that's right.
No such thing.
Thanks for your patience and thanks for attending, everyone. As I said, please call us.
I just have one last thing here. Like, do you conduct these sessions like once in a week, or do you plan it and then you circulate the invites? Like, how does this happen?
At least fortnightly.
Yeah.
Okay.
Yeah, fortnightly.
And at least once a month, we do an education session on tips and traps of property buying.
Yep.
But-
And we will be
Okay.
hosting a face-to-face seminar in the next couple of weeks as well, where you can get to meet the team, and we'll be doing
You'll all be invited to that as well.
yes,
Okay. All right. Cool. Thank you.
no problem. No,
Okay.
but
Thanks,
Listen,
everybody.
for your
thank you
attendance.
all. Thanks for listening, and have a lovely rest of the evening.
Yes. Take care, everybody. Stay safe.
Thanks,
Thanks,
Sachin.
everyone. Thanks,
Thank you,
Sachin.
Thank you all for
Thank you,
coming.
guys.
Thanks all.
Thank you all. Bye bye.
Bye.
Thanks, guys. Take care.
Thank you.
Bye-bye.
Thanks, Wally.